Hello and welcome to another episode of the Hustle to Achieve podcast. On today's episode, we have Gav Blacksburg with us, who is the founder of Wolf Financial, and he has built an audience of 100,000 followers on Twitter. And we are going to talk about investing, finance, and building an audience on Twitter. Thank you for taking out the time, Gav, and being on the podcast. It's a pleasure to have you.
Thank you so much. Excited to get into it.
So please tell us about yourself, your journey prior to building an audience on Twitter, what you were doing and how you got into building an audience on Twitter.
Absolutely. I have a traditional finance background. I went to college, studied finance, graduated. I worked at Goldman Sachs as a financial analyst. My team managed around 5.5 billion AUM. We were investing, but I was mostly client facing, where I would talk to clients on a daily basis and explain to them what was going on in the market, the economy, their portfolios. After that, I wanted to check out the private markets, so I got an offer from Versa Capital Management, which is a private equity firm in Philly. I worked out of there. We were managing about 10 portfolio companies. And again, I was a very client-facing role, so working with the CEOs of these portfolio companies to help them rebuild their companies so that ultimately we could resell them. Following that, the COVID pandemic hit right at around maybe like 6-7 months into that job. And I had an opportunity now with a lot of time on my hands to move into the startup world. So I was reached out to by a couple friends, started moving into the startup world, and ultimately started building on social media because I really saw that as a place a lot of people were going, right? More and more people were jumping online because they didn't have in-person interaction, especially in the finance world, as the stock market, following a brief dip in March of 2020, rebounded spectacularly. And pretty much every single stock was flying, so there were a ton of people that wanted to learn more about it. So I started working on Twitter, trying to build an audience, and ran into Twitter Spaces in around March of 2021. Since then, we're about maybe 18, 19 months later at this point. It's been a whirlwind of activity coming from those Twitter Spaces. My audience has swelled to 112,000 plus. And now I do about 8 to 10 hours of spaces a day, covering every major financial topic from stocks to crypto to real estate and a bunch more.
So when the pandemic hit, a lot of people started creating content, and they used platforms like TikTok and Instagram because of the kind of reach that these platforms had at that time. What did you consider? First of all, did you consider using TikTok or Instagram as a platform to build your audience? And secondly, how did you come to the conclusion, or how did you basically decide that you're going to build on Twitter instead of those platforms?
I had interest in them. I've always been a fan of watching on TikTok and on Instagram and stuff like that. But for me, I really felt like the financial community on Twitter had, first off, just a wider range of people that I could learn from, right? Because going into this, I'm still in a learning phase and I'm still wanting to learn. And a lot of the people that the TikTok and Instagram audience were catering to were people who had pretty much no financial background, right? They were creating a lot of these very basic TikToks, just explaining like simple things. And I think I wanted to be more in the stock trading and stock investing world. And I found that on Twitter. Now, that's not to say it didn't exist elsewhere, but I just hadn't found it there. The other thing was, creating video content is something that you really have to have the right setup for. If you want to be successful in these areas, you have to be able to cut and edit videos to a certain point. Twitter is just easy. It is literally think of something, write it down, hit tweet, and it is out. I could tweet from my bed. I could tweet from wherever I want. It does not matter. And then the other piece with it was really Twitter Spaces. Once those came around, that was a competitive advantage for me over every other platform. So I was really ensnared into the ecosystem once those started popping off.
So I really wanted to talk to you about investing and the current market conditions. So I mean, obviously we know that in 2020 and 2021 we saw a huge bull run, and now we're in a bear market. So in your experience, how has the conditions changed? Because everyone was I'm going to invest and I'm going to put my money into this and that, even in crypto and NFTs. So how did that change take place, and how are people around you viewing the markets as right now?
Certainly we're in a downtrend and a bear market. and the macro conditions such as high rates, rising inflation, Fed that doesn't seem likely to pivot anytime soon, calls for more downside, right? And it shows that we could have further downside. But at the same time, what I try to chat with my audience about is you have to find a strategy that works and stick to it. And you can have multiple portfolios, multiple strategies, but that strategy is something that you don't want to just let up on because of changing conditions. So if for some people, right, their strategy was to dollar cost average over time, and it was to buy broad-based index funds, they shouldn't just stop doing that all of a sudden because the market went down, right? Maybe they should space it out a little bit more. Maybe they should, adjust the amount per month. But if your strategy was, doing that, you should continue doing that. You shouldn't just stop, right? Because let's say the market does, rebound over the next several years, you're getting in at some hopefully decent prices on a broad-based index. On the other side, a lot of my audience is traders, and trading actually thrives in volatile environments. We don't really care if the trend is up or down. We can buy calls, we can buy puts, we can scoop dips, we can do whatever. So, if that's your strategy as well, then you can have a portfolio for that and you can kind of stick with that and trade that. Where I think people run into problems is trying to mix and match in a simple singular portfolio, or just completely breaking away from the strategy that they've been sticking to and just leaving it entirely, right? And on the note of what you said, right, with like less people investing, well, that's probably right for a couple reasons. So the savings rate is dramatically falling nowadays, right? The amount of money that people really have left over after they're spending to actually bring in to invest. So that number is really, really dropping. And that's for a couple reasons. Things are getting more expensive. People are maybe losing their jobs, bringing in less. There's kind of a couple pieces to fill in the ecosystem. So, again, I just preach to people, don't be changing your strategy every month, every 2 months. Naturally you can adapt over time, but like nobody's going to get rich overnight in a market like this. It's just not going to happen. So if you're a day trader, like understand your role, what you're doing there. If you're DCAing, follow that, right? But don't just try to like mix and match and like do a bunch of pieces and be like, oh, the market's down here, so I'm just like not going to put any money in for, 2 months. I'm just going to wait and see what happens. Be consistent is, I think, kind of the best message overall. And if you talk to any I'm not a licensed financial advisor. I'm not telling people, to go, invest in a specific way. But if you go talk to a financial advisor, they're going to say the same thing, right? They're going to talk about sticking to the plan and avoiding the mental urges to, differentiate.
So when you started your investing journey, what was like some of the initial mistakes that you made in the in the stock market? That and also initially when we make mistakes, it's like, okay, I'm not going to go in that direction, or I'm going to completely stop investing because I don't know what it is about. What did you learn from those mistakes, and how did you convince yourself to stay invested in the markets?
Yeah, so initial investing mistakes that I made. So the biggest one, there's two different sides to this because there's investing and trading, right? And again, I talked about how I use separate portfolios and I follow different strategies. On the investing side of things, I do believe that implementing a stop loss or understanding that there's opportunities to take profit off the table when something exceeds rational fundamentals, that's something that I had to learn, right? Because human nature, and here's being a good investor often does involve cutting losers quick and letting winners run. Now, that's not human nature, right? Our nature is we see profit, we want to take it off the table. We see losses, we want to wait for them to get back to green. So you have to flip that mindset as first. You have to understand, okay, I have a loser, I want to get rid of it. But then even with the winners, one of my biggest mistakes was I had stocks that had ran hundreds of %. And I looked at them and just convinced myself that, they were going to go another 50, 100%. And I think that was a mistake of mine, having not understood the fundamentals properly and really digging into, ratios and seeing, are these ratios getting overstretched? Should I take some off the table? At the very least, should I set a limit sell at the level where I think the stock is fairly valued? Right? Something along those lines, because so many people had such great gains through 2020, myself included, and many of those we did let slip away over the last, couple of years. Now, not all of it, hopefully for most people, but there were certain opportunities, a stock like C Limited, right? The stock was cruising hundreds of percent, and now it's down from like $400 to trading at $50, right? But any time on the way down, people could have sold some. They could have bought back in if it started on an uptrend again, right? Those are just the type of things which I think are lessons learned. And then the other piece is just really, really, really being careful with your money and always taking a look at something and measuring risk to reward. For example, now outside of the stock market, there was a lot of stuff that went on in crypto, right? With crypto staking, with small coins. And I think what people were looking at was the potential for, gains, and they traded security away from it, not understanding that their money wasn't secure, it wasn't backed, and it could be taken away from them. So that's one of the things that I had to learn as well, was weighing, okay, hey, here's something where I could make some good return, but is that return worth the potential downside, and just having guards in place. And ultimately what I have learned from there is it's okay to invest in risky opportunities. You just have to really, really, really position size down, and you have to diversify your portfolio, and you can't take 50% of your portfolio and put it into something that is a risky asset, right? You can have those in there, but you can't go and put everything into them. And that's something that, I think people learn over time, and, losses are learning experiences.
Yeah, so I mean, absolutely, as you mentioned earlier, that where we have this psyche wherein, like if we're having, like if you're in profits, we want to book the profits, and if we are in losses, we wait till it, like like our portfolio gets in green. So let's say, like obviously we need to understand that it's important for us to let our winners run, but how do you basically come to that conclusion? Let's say, like I'm in profits at this point, and I'm going to take off all the initial investment that I made. How much after that I'm going to, like keep invested in the markets? So how do you come to that conclusion? What is your strategy like?
Yeah, I like to trim in waves, right? So this is where position sizing off the bat comes in handy, because if you go in and buy something, let's say it's a option contract like a leap, but you only buy one, you're never gonna have an opportunity to trim, because selling one is selling your entire position, right? So it's first off understanding, like, this starts at entry. This starts with how much am I buying up front, and then over time, how do I scale out? And one of the best ways to use it is combining fundamentals and technicals. So, for example, there's a stock that I really like. It's Celsius, CELH. Now, I understand both the pros and the cons for this company. Pros, amazing growth, beating on revenue, beating on earnings. Cons, a very stretched valuation, right? It is a very stretched PE valuation in an industry that does have that, but still, it's abnormal. Now, I look at a stock like this, and I take a look at the chart, and I say, all right, on the chart, where is the 50-day moving average? Where is the 200-day moving average? Where is the 100-day moving average? Simple pieces like that, as well as a little bit more complex strategies like an anchored VWAP, like a design level of support and resistance. Those can be places where you can set buy, sells, trim. Sometimes you can even automatically link it to them. So for me, right, CELH has traded all the way up to $116 per share. It's currently trading at $90. When it was trading over 100, people asked me, hey, where's your trim point, right? Because they were like, I was like, I'm not selling just yet, right? Where's your trim point? Well, I said, my trim point is the 50-day moving average. 50-day moving average is trading at 97. And what's wild is you can actually see the 50-day moving average gets broken, and the stock immediately drops like 10% from there, right? So I was like, having these key levels and mirroring and marrying the fundamentals with the technicals allows me to understand why I want to be in the stock long term, but also in the short term, why I want to take some off, and then where I can get back in, right? So I might say, all right, 50 days getting broken, let me sell a quarter of the position here. Now we're getting down to the 200-day. All right, I think that's more serious. I'll take off 40% more of the position here. Oh, we're back above the 200-day. Okay, I can add back in, right? Pieces like that. So I like to marry fundamentals with technicals, because, I talked to my friends who had just never, ever looked at, technical analysis. They're all purely fundamentals. And I tell them, I was like, you don't have to overcomplicate this, right? You can use a 200-day moving average. For example, on the S&P 500, and this is, now, listen, there's two ways to go about this. And the biggest thing I have to stress is, it all depends on how long you're investing for. The way I invest as a mid 20-year-old is going to be so different from a mid 50-year-old because of timeline. But what I was telling them was, if you have an account where you're liking, the ability to maneuver, if you simply bought the S&P 500 when it broke above its 200-day moving average and sold it when it went below, you would have booked all of the gains of the COVID run, and you would have sold like, 30% ago, like 20% ago, and you would have maybe gotten back in once or twice, but you would have sold out, right? Like simple lines like that. And now that's not going to work for everybody, and there's different pieces to it, but I kind of like to use those as guidelines. But again, for me also, it's helpful to have multiple portfolios that I can implement, a strategy and stay consistent with that strategy in that portfolio. So I might have one more actively maneuvering one with that, but also I'm young, I have a 30-year time horizon, so I can also have a DCA portfolio, right? But if you're literally, 10 years from retirement, I would be scared to not be selling anything as key lines get broken. I would be terrified, because how do I know it's going to come back in the next 10 years when I need to retire, right? I'm confident over 20, 30 years, but right, it's just different per each person. So that's why it's helpful to have a financial advisor that can kind of build a customized piece for your situation.
So, as you mentioned that, when you're looking at profit booking scenario when it comes to selling or holding a stock, you combine both technical and fundamental analysis. You look at 550-day moving average and then 200-day moving average. But when it comes to, let's say, when you're doing fundamental analysis, what are the top 5 key indicators, or the things that you're looking at when you're investing, let's say, for a five-year horizon? What do you look at?
Yeah, so my top 5 fundamental analysis pieces that I try to get a check mark on are, first, valuation, right? So that's kind of self-explanatory, and that's where you're really using often a DCF model, where you're actually modeling out the future cash flows, and then you're discounting them back to today, and you're finding a fair value share price. Number 2, I like to use, and also for valuation, you can also use PE ratio, you can use other ratios, whatever is really best with your system. Number 2, I like to use growth. So growth might be a little bit more hard to measure, but things that I really like to look at in growth are, revenue growth, EBITDA growth, EBIT, EPS, free cash flow, right? All these type of pieces I think really help with growth and seeing them move year over year. And sometimes people want also a specific percentage of growth, right? So they want to see I want to see 60% growth. I want to see whatever. Having an understanding of that, that's going to be helpful. The third one, and one of the biggest things that I look for in a market like this, especially in a recessionary environment, is profitability. I do not want to be investing in companies that are losing massive amounts of money in a recessionary environment. It is bad for business. So profitability, super important, right? Looking at the gross profit margin, looking at the EBITDA margin, looking at the levered free cash flow margin, looking at return on total assets, asset turnover ratio, CapEx to sales, right? All these things are really profitable and helpful. Another thing that I really do like to keep an eye on as well in this market currently is momentum. When a stock is just falling and falling and it's down 50, 60, 70%, sometimes even if they are profitable and they have other, strong things, the momentum is just against them. People are just underwater on this thing. They're looking for any opportunity to sell. Any day of green could just lead to another sale. So you want stocks that have strong upside momentum. And then the last thing that I find to be pretty important is actually revisions. And that's really specific to earnings. I want to see a company that is not lowering expectations consistently, because that means that they have first of all, they're doing a bad job projecting, right? They're not doing great there. They're sharing inaccurate information, and they're having to go back and having to revise. And that means that they're running into internal problems, poor timeline management. So I want a company that is not revising earnings a ton. And if they are revising, I want them revising to the upside. I want higher expectations, right? I don't want more conservative expectations. So if you can really nail down those 5 items from valuation, growth, profitability, momentum, and revisions, I think you're doing pretty good for due diligence on a stock.
So you mentioned profitability being a huge factor in making a decision when it comes to investing for a longer period of time, and this brings me to my next question. I wanted to ask you, because I mean, in the last 2 years, specifically in 2020, we saw a huge upside in growth stocks. But right now, all of the major growth stocks are down. They're very, very much in shambles. So when it comes to your portfolio management, especially in times the current times, what percentage of your portfolio would you put in growth stocks as compared to let's say value stocks or dividend stocks? How are you currently managing your portfolio in that manner?
It's a good question. Some growth stocks can still be profitable, right? Like that's definitely something that can happen. Even within growth, you can find profitable companies. And nowadays these large caps kind of get pushed into growth still as well. Even like an Apple, like in others, like they still kind of fall into like growthy areas. So I still think that they can make up a large percentage, and again, this is where it's so timeline based. Because somebody that's in their 40s, 50s, they might want a bunch of dividend stocks. They might want the security. I don't need that, right? I can go 60, 70% growth, right? Like I can just be a higher percentage. So it depends on the area. But just to kind of elaborate on what you're saying and what I was saying, growth stocks severely get hit when interest rates rise. Because for anyone who's unfamiliar, one of the most common ways to value a stock, which I mentioned beforehand, is a DCF, discounted cash flow model. And the way a DCF works is after modeling out future cash flows, you use the denominator to discount them back. And in the denominator, there is an exponent, and that exponent is current interest rates. So as interest rates go up, your denominator becomes a larger number, meaning the price of value goes, the price of the company goes down because it's getting divided by a larger number, right? So especially for companies so every time that interest rates rise, every growth company typically is now worth less. And if you're also losing money and now you're getting a devaluation, that's just multiple areas getting hit. So that's the way I'd put it.
This actually brings me to talking about crypto, because I believe crypto can also be viewed in a similar sense when we look at growth stocks as well as crypto, because I mean both the growth of the cryptocurrency sector is actually based on the future value that we look at, right? How did you make way through, let's say you earlier mentioned that you followed a similar strategy of investing in risky assets. So how much of that was in crypto and how much was in growth stocks and stocks in general, and even right now, during the current market situation?
Yeah, I had points this year where I was very heavy in crypto. However, I was never really too heavy in volatile cryptos. So, I began buying Bitcoin around $9,000-$10,000 a Bitcoin, and I sold most of that position in the 40,000s. And then I also was buying ETH around $600-$700 a coin and sold most of that position in the 3,000s. So those did pretty well. Most of my crypto positions were actually in stable coins, and then those stable coins were getting staked for rewards. And even though they were stable, I had to, realize, and I took some losses, which ended up helping me realize further, that they were still in volatile positions because staking was a volatile industry with the loans that were being made, right? So you have to understand, even if the crypto itself isn't moving that much on a daily basis, there's other factors that can come in and make something risky, whether that's security, insurance, whatever it is. At this point, I still do hold an okay amount of crypto. Bitcoin and ETH have been basing for a little bit, so I do have several ETH that I kind of hang on to just in case, a little bit of Bitcoin, actually some alternative tokens that have been doing pretty well lately. There's been a nice little run in some of the alts, but they're not, right now they're actually probably a larger percentage of my portfolio than typically. I'm probably 25% in crypto right now. But that's actually a bit of an abnormality. I just had some positions that did pretty well lately, and so the position portion swelled. But I think for somebody that's young, interested in this type of stuff, it's okay to have 20 to 25% of your portfolio in riskier assets, whether that's crypto, growth, whatever it is, or even private equity ventures, angel investments, because I wouldn't put growth stocks in the same category if you're picking growth stocks with strong fundamentals. It's going to be different for each person. It's going to be what you're comfortable with. If you're going to have these things on hand, you should also still hold a large cash position because you just don't know what's going to happen. It is a pretty wild west right now. And the best thing that you can do is, before you invest in anything, really, really take the time to look into that investment beyond just, a tweet on Twitter. Like, you see a tweet and you're like, oh, that looks good. You really want to take a little bit more time than that to push into things and really be like, okay, are they actually profitable? What did their team accomplish before this, right? Like, who is their CEO? Who is their CFO? Who's their COO? What have they done in the past? Have companies that they've touched been successful? How is their funding going, right? Do they have cash on hand? Because there's certain companies that you can look at and you can actually see Robinhood is an interesting company, and I was not a fan of the stock for a while. But when Robinhood got down to trading at $8 a share, they basically were trading at the value of the cash that they had on hand. They had $6 billion of cash on hand, and they were trading at that value. So it becomes a more enticing offer, right? But people who didn't research the company aren't going to know that. So you really got to look into things like that. Now, that's just an example. I don't own Hood stock at the moment, but seeing companies that you like with good business models drop down, and then having an understanding of all right, really thoroughly vetting the company, those can be good opportunities. But again, other things factor in, like momentum and stuff. So it's stock by stock basis, full review for each one. You worked hard to make money. Don't give it to someone else without making them work hard.
As you earlier mentioned about the fundamentals that you look at when it comes to investing in stocks, crypto, on the other hand, it's a lot more volatile than stocks are. What is your thesis behind investing in the cryptocurrencies that you are investing in, and how do you basically do your research when it comes to picking up a particular crypto to add in your portfolio?
Yeah, so first off, like I said, typically it's a smaller percentage of my portfolio, maybe 5 to 10%. Just happens to have swelled lately because of some decent gains. With those, majority I'm typically sticking towards, the large ones, the Bitcoin, the Ethereum, and others. The way I look at it right now, I can pull up the Ethereum chart to get, because first off, obviously with a crypto, you can look into leadership to a point, but there's not really fundamentals, right? You kind of have to you do have to use the chart, more than you would with other stuff. So, with Ethereum, it's been doing this basing pattern for a while at this point. The stock really hasn't moved in 3 months. I mean, it's up a little bit over the last 3 months. And, really even since June, it's just basically been flat. And there's been a lot of downside pressure, right? The stock market's gone down during that time. There's been bad news. There's been inflation. There's been other stuff. So I like that it's been holding there. I do see so much built on Ethereum. I think that, these cryptocurrencies are a big part of our future. I use them for payment as well. So, for me, I'm seeing ETH hold pretty steady here. So that's why I've accumulated a few. Now, also, I'll say I'm a little bit of a special circumstance because people will often pay me in cryptocurrency. So sometimes if I feel like that crypto has a decent potential run coming, I'll hold it for a little bit just because it's a little bit more just convenient to just hold it. Outside of that, if I'm looking at an alt crypto, it's I'm looking for catalysts. I'm looking for companies that are about to make a big splash into the crypto world. And like I talked about before, team is super important, vision super important, funding is super important, established partners, advisors, people on board, all super important. And then catalysts, what are they delivering? When are they delivering it? How many people are going to actually know that they've built that, right? So just looking towards that, because there are a lot of people that are building really cool stuff and are going to launch really cool stuff, and they're going to do millions and, hopefully billions in volume over time. And I don't want to miss out on that, but I have to be really careful with where I do put my money. And I have to also, like we talked about before, understand how to take profit, because even though like I was in a crypto this week that's up actually 40% this week. And yesterday, I sold a portion of it. Now, I did not want to sell. This thing was, flying, and I think there's upcoming catalysts that look good, and there's a team. But when something's up 20% in 2 days, I need to take some profit. I need to be a smart investor here. Now, listen, I took 20% yesterday. It went up another 20% today, right? And do I look at myself and go, oh man, like, what did I do? No, I say, I did the right thing regardless of what happened today. I took some off the table. I live for another day, and I still have a portion there. And that's the kind of the beauty of trimming. So hopefully that kind of creates a picture as to like how I approach crypto investing and still trying to be a smart trader. And to be honest, I think if people are going to invest in this stuff, you shouldn't be doing it alone. And you should be networking with other people that are investing as well. And you should be bouncing ideas off of them and getting thoughts and working together to get a full picture. Because, I mean, that's why we have social media, is like so that we can like work together. It's a hive of minds. 100 minds is better than one.
Absolutely, I totally agree, and which brings me to my next topic I actually wanted to talk about, and we earlier also discussed, which is Twitter, building a brand on Twitter. So we talked about how you started your Twitter account, and how what were the strategies that you implemented early on, and later where you talk about Twitter Spaces, how what were the strategies that you basically put forward, and even right now what are the strategies that you're using to basically grow your presence on social media, especially on Twitter and other platforms?
Yeah, a significant amount of my growth comes from Twitter Spaces. And that's just putting in the time, like I'm putting in several hours a day. I'm live, and I'm also trying to bring on really talented and smart guests so that people want to come back to my show. So I'm bringing on like 100 guests a week. I'm coordinating all their schedules, coordinating all the times, leading the conversation, keeping it on topic. And that's a great way that I grow, is through Twitter Spaces. Outside of that, it's having consistent messaging through my tweets and sharing content that I think people need to hear. And that comes in two forms. Sometimes it's more analytical. For example, I put out a tweet today where I said, here's 10 stocks that every investor needs to be on top of or needs to have a good knowledge of for the next 10 years. And they're not, mind-blowing stocks. It's Apple, it's Google, it's Microsoft, it's Disney, it's stuff like Enphase. But the thing is, there's people out there that don't know this stuff. Like someone commented and they're like, oh, every stock that gets talked about on major news networks, how wonderful. I was like, great, like you watch the news. There's people out there that don't watch the news, that don't follow this stuff, but everybody needs to be investing, right? Everybody needs to be investing. That is the only way that in reality you're going to be able to retire and, live happily ever after, that kind of stuff. My message is great, maybe there's people that don't need this, but somebody needs to see this. And then the other side of it is just motivation, right? I think motivation through social media is huge. I have, had times where I'm on TikTok and I watch a video and I'm like, damn, they made a good point. I should go work out. I should go do this, right? And so if I can press people on my timeline every single day and explain to them the value of investing and the value of making their capital appreciate, and one person goes and makes an investment that day and, buys something that ends up making money, that's my job well done, right? It may get repetitive at times, but people need to hear it.
So, you earlier mentioned that you're hosting spaces 8 hours a day, and I saw your schedule wherein you'll be hosting, let's say, an options trading spaces, and then Web3 and crypto, and then investing in stocks. So how did you so initially when you started out, how was that planned out, and how did you basically convert it into what it is right now? How did you come to that stage wherein you decided to basically have specific spots in a particular day to conduct these specific spaces?
Yeah, when I first started out Twitter Spaces, I actually thought people wouldn't want to be overloaded. So I was just doing one every other day, because I was I don't want to piss people off. I want to be all over their timeline. But what I realized over time was people want these things every day. They want them every hour. They really want to just tune in and listen. And I can understand that because I'm a big podcast person. Anytime I listen to music with people. I don't really listen to a lot of music myself. I just listen to podcasts. And I'm like, okay, if I'm doing this, probably there's people that just want to tune in and listen throughout the day. And I basically just started realizing that people wanted more content. So I was just ramping it up. And along with that, I've always been a networker. I've always been someone that tries to create relationships. And I found that these Twitter Spaces were a great way to bring people into the loop, because I could tell people, hey, if you hop on my space, I'll have 1,000 people there for the hour to listen to you and hear you, and you'll get followers. And it was just a great sell. So I was able to bring people in. And, over time, as I became a bigger account too, it became an easier sell to people because I'm kind of known as like the Twitter Spaces guy now, right? I built a brand around it. So it got easier to bring people on. Now I have like CNBC contributors that come on regularly, large scale investors, people with 8-figure portfolios, that kind of stuff that are coming and trading with us. So it's really become like a self-fulfilling prophecy. But the beginning was just putting in the hours, man. I mean, I spent 60, 70 plus hours a week on Twitter for months and months and months to just build.
So right now, when you're conducting these spaces, let's say you have one topic. Let's say you're talking about options trading, and you're like conducting these spaces for, let's say, 1.5 or 2 hours. Then again, like when you go back and you conduct another spaces the next day on the same topic, how do you basically come to the discussion or conclusion rather that you're going to talk about this particular thing because the other one was already discussed the previous day? Do like the guests on your show, they do you consult with them, or how does that happen?
So typically everything is planned the week ahead. So I schedule out, and it's my pinned tweet, so you've seen it, I think. I schedule out all the spaces, and when it's a stock market space, there's always something new to talk about. There's always news. Stocks are always moving. Someone's always taking a trade. So anytime I'm trading during a high volume period, that's easy. The conversation comes naturally. So basically from like 9:30 a.m. to 12 and 3 to like 4, like those are easy hours. We could come back with the same people every single day, and we'll always have something new to talk about. Outside of that, I try to space some other space. So I do one real estate space a week because the real estate industry is changing, but it's not changing that fast. So I think, one a week is going to keep people updated. I try to do one space on Tesla every week, right? Because I think that that's a really interesting, unique topic that people want to hear about. And then outside of that, to be honest, a lot of the spaces that I do are from people reaching out to me and saying, hey, I'd love to hear something on this topic. Or I really want to, discuss this company in a space. And I kind of field those and I say, all right, that sounds good. And then I kind of think about, all right, who would be a good speaker for this? And then I craft that space. So that's how I really go ahead putting together topics.
That's pretty interesting. I mean, it takes a lot of time and efforts to basically arrange and schedule these.
I'm always on my phone. Always.
Yeah, I mean, I saw it on your profile that you've hosted 2,500 hours of spaces. So what is at this point of time, what is your goal with Twitter Spaces, and where do you look at expanding your brand in what areas are you looking at, or what platforms are you looking at right now?
Yeah, my goal is to maintain my spot as the #1 host for investors of all types. I want to continue to grow on there. I'm also trying to grow in other, places. Building up on Instagram. I've been putting out a lot more video content on YouTube. Hopefully putting some stuff out on TikTok. I'm working with different companies that are trying to take my Twitter Spaces and turn them into TikToks and Reels. So just disseminate the content across. And then, as the Twitter Space area grows, maybe I'll even bring another person in to help run some spaces on my account, right? Just have more content coming out through there. So maybe because there's foreign markets, right? Like what if someone's hosting when I was asleep and they were just talking about Chinese markets and trading foreign currencies? I think people would be interested. They might not have as many listeners as I do during the day, but it can't hurt to, bring them on and something like that. And then outside of that, I'm trying to also expand to more in-person pieces. So I've been speaking at a lot of conferences lately. I was just at 2 conferences in Vegas over the past couple of weeks. I'm going to 3 more conferences later this year that are planned out, hopefully some next year. So just trying to take what I've done on social media and bring it to in person, where I can have live panels and live discussions and pitches and stuff like that in person, because I really do enjoy that type of activity.
Interesting. Just a couple of more questions before we wrap up. So I wanted to talk about the monetization aspect of Twitter. How do you basically monetize your Twitter, and how can a content creator who's creating on Twitter basically find ways to make money on the platform?
Sure. There's a number of ways that you can monetize through Twitter. I personally do most of mine through Twitter Spaces. So I work with companies similar to a radio station where they sell hours of time and ads and stuff like that. So people will hear, ad reads in my Twitter Spaces. However, all the products that I'm promoting typically are things that I'm personally using. and I've worked with them to just get a better deal for my audience. For example, I work with Seeking Alpha. I'm excited to have a long-term partnership with them. I use Seeking Alpha every single day, and I was able to get a 60% discount on their yearly subscription for my audience. So now I'm promoting it to them, but I'm also giving them like a huge discount, right? So that's kind of how I make a lot of my money off Twitter, is by kind of being like a radio show where I'm selling ads. You can do a bunch of other stuff. People sell tweets, they sell retweets, they sell engagement, they sell all different types of things. I don't do as much of that, but I know that there's a big market for it. And then the other thing is, you don't have to necessarily monetize off of Twitter itself, but you can really just use Twitter as a funnel, right? If you have a great offering and you're selling people, let's say you're a tax accountant, or you are, somebody that is doing SEO or whatever it is, you don't actually have to sell anything on Twitter, but you can use Twitter as a funnel to get people to your product off of Twitter. So regardless of what your company is, it's typically helpful to have a social media presence to work as a natural marketing funnel to your product.
My final question is, how can someone who's starting their journey on Twitter or any social media platform for that matter, basically focus on creating content, and what are some pieces of advice that you would give to someone who's just starting out?
Well, if you're doing it on Twitter, there's a lot of great ways to create content, but the thing with Twitter is it's just people saying the same thing 1,000 different ways. It's very hard to put something out onto the internet that hasn't been said before at this point. There's just too much content. So there's great services, for example, like a Tweet Hunter or a Hype Fury, where these are services where they actually help you write tweets. They help you come up with content by basically showing you what's been successful in the past and allowing you to adapt it and add your own unique spin onto it. So I think if you want to be viral on Twitter and be successful, you got to look at what people have done to be successful and study that. It's the same thing on Instagram. There's an algorithm and there's people who have been successful within it. And in order to be successful as well, you kind of have to mimic some of their actions and learn from people who have walked before. So it's like not trying to reinvent the wheel. It's just looking at how do these social medias actually work? How does the algorithm pick you up? Like Twitter hates when you post links. It doesn't want you taking people off the platform. If you post links, you're going to have lower engagement, right? They're going to push less people to your page. Twitter loves threads. It wants people to click in and read your whole thread and stay there for longer, so it promotes threads, right? Just having an understanding of how social media works is really helpful for growth.
Thank you so much for your time. Just before we go, can you please tell us where can our listeners find you on social media?
Yeah, absolutely. Twitter's best. They can go to wolf_financial. It's a verified account on Twitter. They can hear all my Twitter spaces there. They can see my weekly schedule. And if they want to find my other social medias, they're linked in my bio.
Again, we'll mention your Twitter handle and your social media platforms in the description. Again, thank you so much for being on here and taking out the time to teach us about Twitter brand building and obviously investing in the markets. Again, thank you so much.
My pleasure.